Let's get talking to a company now, CCL Products. The board recently approved demerger of the marketing and distribution division of coffee and FMCG products of Continental Coffee into the parent. Challa Srishant, who is the MD at CCL Products, is joining us now to discuss this demerger, a lot more about it and the business outlook as well. Mr. Srishant, good afternoon. Thank you so much for joining us here on CNBC-TV18. First up, I wanted to understand the rationale behind this demerger. And once the demerger happens, what are the two entities? What will both these entities entail?
So the main reason for this demerger is operational efficiencies, actually. The current subsidiary entity has two divisions. One is the branded business, the B2C segment, what we are selling as our brand Continental Extra, Special and Strong. And the other entity is the kiosk business. We've set up about 15 kiosks in Hyderabad in the metro stations. And this is a completely different type of a business model, which has now become self-sustaining by itself. So the idea behind the demerger is we wanted to consolidate all the brands in the parent company. And we wanted the subsidiary company to focus on expanding the kiosk model on a pan-India basis.
But you said your brands is also a part of the subsidiary, right? We're still a little unclear about the division of your business.
So the brand Continental Coffee and all the brands are actually owned by the private company. CCPL was created primarily as a distribution company. So now, because of this, we're consolidating all the brands, the marketing, the distribution, everything under the parent company. And tomorrow, we are also planning on launching on an international scale. So keeping all these things in mind, we have the exports efficiencies for coffee. So if you consolidate the brand, it will be easier for us to launch outside India as well. Oh. So we are doing all this because we want to do this launch sometime next year. And we are preparing ourselves for that right now.
Okay, so one of the reasons which you said is operational efficiencies why this demerger is taking place. And you also talk about cost savings which are expected to flow from more focused operational efforts. Have you quantified what kind of operational efficiencies or the cost savings that you will see from this particular demerger? Can you quantify that for us?
So we're actually coming up with a go-to-market strategy for the entity that's going to be the kiosk entity. So I think in the next 2 to 3 months, we'll have a clear plan of action in place. So after that, we can more confidently tell you that this is our vision and how we're going to take it forward.
Can you tell us the size and the profitability of the two entities now?
So right now, on an MIS basis for the domestic market, we've already broken even. And the kiosk business is actually a very, very small fraction. It's about a little less than 1 crore, which we are doing in the kiosk business today. And this includes our central cloud kitchen as well as the coffee on wheels, that's food trucks, as well as the kiosks that I was mentioning. Okay. And the rest of the business, which is about almost another 200 crores or so, that will get merged with the parent company.
Okay. I wanted to understand while we are talking about cost savings here, since now the demerged undertaking has marketing and distribution of coffee and FMCG products and the kiosks as well, that is coffee on wheels. Will you not look at putting in more capex in this segment in order to expand it? Will the marketing and distribution expenses go up here and then the net effect of cost savings will actually be nil? Are you looking at investing more money?
Not really, actually, because we've already come up with a self-sustaining model. Once we merge the branded business with the parent company, that will be the expansion will anyway take place. We are already budgeting in for the marketing expenditure, so there's no issue over there. The entity that was going to be left behind, we're trying to come up with a more self-sustaining model. We've done the proof of concept in Hyderabad, and the idea is to go to other metros as well. So when we go to other metros, we are still exploring whether it should be a company-led approach or a franchisee model or a hybrid model. So that is something which will take us some time to come up with a proper go-to-market strategy. and we'll take it forward from there.
Will the demerged entity be all? Will you look to list the demerged entity?
It's too early for us to
What is the thinking?
contemplate that right now. It's going to be the same, Continental Coffee Private Limited.
No, but
It'll
are you
remain the
veering
same.
towards listing it, or do you want to scale it up before you list it? I mean,
We definitely want to scale it up. Whether we list it or no is it's too early for us to comment on that right now.
Okay. So let's talk about the business generally. You had guided for a volume growth of 20 to 25% for FY23. How has Q3 been so far? What is Q4 looking like in terms of demand in both in export and domestic markets? Because we've been hearing that export markets are not doing so well. Is that the case for you as well? That's what other industries have told us.
Okay. So fortunately for us, coffee is a product, let it be during recession, let it be during pandemic. Coffee sales have only increased. And fortunately, that's one of the things that we're seeing even now. Q3 is actually a peak period for us. And Q4 also, we already have our contracts in place at least 1 year in advance. So we're kind of already about 80% pre-sold for next financial year as well. Most of our customers, as you already know, our business model is we first sell and then cover the raw material. So we have good visibility at least for the next 1.5 years.
Just the company which is going to be left behind in the listed entity, CCL Products now. Could you tell us the size and in terms of a revenue as well as margins? And once those cost efficiencies kick in, what could you scale up the margins to? Some numbers, Srishant.
So if you're talking about our the branded business that we are talking about, it's about 200 crore revenue that's coming in from not only brand, but also from the private label domestic sales that is there. And right now, because of our expenses and everything else, our margins are actually on the lower side. But going forward, as our economies of scale increase, we're looking at a much higher number over the next couple of years. So eventually, our target is over the next 5 years, at least a 30-35% gross margin is what we are looking at. So that is our eventual objective. And once this consolidation takes place, it should be that much easier for us to achieve that objective.
Okay. All right. It was a pleasure speaking with you, Mr. Srishant. Thanks a lot for joining us and telling us all about this demerger and the general demand on ground as well. That's the word coming in from CCL Products.